Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi. I'm the Chief Investment Strategist at Standard Chartered Bank India. We've just released a monthly India market outlook titled Looking Through Volatility. In today's podcast, we summarize a key question: how should investors navigate an uncertain market environment? In subsequent podcasts, we will get into more details on our macro and asset class views. Indian equity market seems to have hit a rough patch after scaling new all-time highs last month. Volatility, measured through India VIX or the volatility index, has risen to a 19-month high as investors turn cautious ahead of the Lok Sabha poll results, successive high inflation readings in the US that has pushed back expectations of Fed policy rate cuts, and escalating geopolitical tensions in the Middle East. Domestic bond yields have also been volatile alongside the pullback in equities, raising investor concerns that there could be limited places for investors to seek refuge. In the face of this significant near-term event risk, how should investors navigate the shifting and volatile environment ahead? Well, the three following key takeaways are likely to help investors. First, stay calm and do not resort to panic selling. It is important to recognize that it is not normal for equity markets to experience bouts of volatility. History has shown that the worst days in equity markets have tended to be followed by its best days. Therefore, panic selling during periods of declines and heightened volatility can significantly lower returns over the long term for investors. Also, drawdowns in the Nifty index have rarely exceeded 10 to 15% outside of global shocks and recessions. We expect further downsides in the Nifty index to be limited, given robust domestic macro fundamentals and a view of a soft landing in the US. The second takeaway is a well-diversified portfolio is key to navigating the uncertainties ahead. Investors need to maintain an allocation to equities to benefit from the upside should economic conditions remain resilient. While Indian equities have witnessed a pullback lately, we believe the medium-term outlook remains supported by strong positive drivers which include robust domestic macro fundamentals, strong corporate earnings cycle, and a gradual improvement in private consumption. On the other hand, allocation to fixed income or bonds can serve as a hedge against the risk of a domestic growth slowdown and give a steady source of income in the portfolio. The recent surge in domestic bond yields has improved the risk reward for the asset class. We believe this presents investors an opportunity to lock in still attractive yields, especially in high-quality corporate and medium and long duration bonds, given a view of a likely peak in interest rates in the current cycle. Further, an allocation to cash and liquid alternatives provides a source of less correlated returns. Cash allocation can also serve as dry powder to take advantage of the short-term pullback. Third key takeaway is that gold's role in the portfolio remains compelling, even as the risk of a pullback remains high. In India, gold enjoys strong domestic tailwinds amid resilient household demand for jewelry and as a traditional store of wealth that passes on for generations. This in part explains the resilience of domestic gold prices and its lower sensitivity to shifts in global macros. More recently, gold has decoupled from historical fundamental drivers such as real rates and the USD rally to fresh record high. Though we remain neutral on the asset class, gold's role in the portfolio as a hedge against geopolitical tensions and inflation remains compelling. Gold has shown the tendency to be an all-weather asset with the ability to provide positive returns during any growth inflation regimes. Our analysis showed that growth has delivered positive returns whether India has gone through a reflationary environment, stagflationary environment, disinflationary, or a Goldilocks environment. While you do follow these three key takeaways closely, opportunistic allocations can improve your risk-adjusted returns. Investors can buffer their foundation allocations with opportunistic allocations to improve overall portfolio performance. Within equities, we continue to see value in manufacturing and infrastructure, with multi-year structural drivers still in place for these sectors. We prefer a barbell approach on sectors through an overweight on domestic cyclicals like industrials and consumer discretionary, along with a defensive overlay through an overweight on healthcare. Within bonds, we see attractive risk reward in corporate bonds, especially in high quality or AAA rated bonds, given their cyclically high spreads over government bonds and the lower sensitivity to changes in interest rates. At this point, I'll take a pause and thank you as always for listening. Do reach out to your relationship manager for a copy of your market outlook. You could also log in to sc.com/in and find a copy in the SC Invest section.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered relationship manager or visit www.sc.com/in.